Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from CIBC Wood Gundy reviews the year's winners and losers in the markets. Publisher of the Trends Journal, Gerald Celente, will tell us about what he believes we'll see in the new year and how it could affect your investment decisions. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy. Merry Christmas, Ross, and Merry Christmas to your family.
And the best of the season to all of yours.
We're going to kick off today's This Week in Money with currencies. The U.S. dollar, the big gainer this year.
It was, there were some really dominant trends out there in 2014, and clearly the strength in the U.S. dollar starting last spring is right near the top of the list. The bond market is up there as well. U.S. large cap equities, the technology stocks, healthcare, pharmaceuticals. As the money came into the U.S. from all of these other areas, whether it was from Russia, Europe, Canada, it was going to the big name items where there was depth of the marketplace. And on the other side of the coin, when you've got strength in the dollar like that, then you end up with commodities being weak, and not just the oil market, which had peaked at 107 during the summer and ends up here down, dramatically off the highs. But so to take these a step at a time, the dollar. We've been looking at this as a big 15 to 16 year cycle that the dollar is in. It was overdue to finish a basing pattern last year. It made one attempt to get off the bottom and break out in 2013. Couldn't quite do it. And by the spring of 2014, it was on its way. So, what you've got here is a 14% move since June, which is pretty much in line with the two previous cycle points that we're looking at. The 16-year cycle, if we look back to the early 80s and we look back to the late 1990s, the 2 points on that cycle, when it started to break out, it was just relentless strength, small pullbacks. We had a couple of pullbacks this year, but they were limited to maybe 3% or so for the two corrections. I was thinking we might get something a little bit deeper, but the strength there is carried right through to pretty much right into the end of the year here. Dollar's sitting up at 90 and a quarter. Resistance from our measurements sit up around 92, so roughly 2% above here. And still have the mindset that any correction that gives back 40% or so of the gain from last spring should be viewed as a buying opportunity. I'm not looking for a top as much here as we are just looking for the next good buying opportunity.
What about other currencies? The euro, the economy in Europe has been bad the past year. Has that hurt it?
The euro continues to slide. The yen continues to slide. They both attempted rallies here a month or so ago, but I don't see too much on the horizon there in terms of major upside. I think as the dollar maybe bottoms out or tops out and has a little correction, you could see a bounce in those currencies, but trend is going to continue down. And then if we look to the Canadian dollar, here, my picture here that I look at is pretty clear. We had that big, broad trading range from 2010 right through until November of last year. So you got a good almost 4 years worth of trading. And once it broke the 94-cent level, it last year at this point, it quickly gave up ground into February. And then we had a subsequent rally, which was part of the lift that we saw in commodities, and in particular, it was part of that oil rally to $107. Boy, wouldn't we all like to have that number back again? So after testing 94 in the summer, then we've seen it give up a full 8 cents against the U.S. dollar as it was coming to life, and these commodities came unglued. And it wasn't just the oil market. I mean, it was the grains, it was coffee, it was, you just look around the board. I think about the only thing that was rallying were the meats, and that I don't follow very closely. But you look for something that was doing better, and that was about the only thing we see. So if we take that top from 2010 through last year, we measure the height of that, we look at the style of the corrective rally into the summer up to 94, that provides a very nice downside measurement. We've been talking about 84.60. I think that number still is viable. It's a couple of cents from where we are right now, and I think it's a level that is it's within earshot here. And from a seasonal perspective, December tends to have an upside bias, and all we're doing during December this year is just managing to hold our own. So when the weak periods of January, February come into place, that could be just enough to give us that last little break into the target.
How are the bond markets, and how do they do over the year?
Well, the bond market was, the one market a year ago that everybody was worried about higher interest rates just around the corner. And boy, did we have the opposite of that. You got, the front end of the curve, the T-bills, the one-year rates, they didn't move much at all. When you go out on the curve to that 10, 20, and 30-year spot on the bond market, it was just a fabulous year. The bonds, the 20-year bond, had a total return of 28%. Price, taking into account price and the coupons received. And if you're a Canadian, that worked out to a 40% pricing or return on capital. So at the end of 2013, just a year ago, we look at the long-term charts. The bonds were at the bottom end of a rising channel that dated right back to right to the early 80s, I think 1980 or 81. And so there were some good bullish divergences down there that we saw. We were against long-term moving averages, the 100-month moving average, got the turn, and then by April, and this became a real key again in the bond market, that the quality spreads really started to kick in. The high-yield bonds started to give up ground. So that's the HYG, the JNK, and on the other side, the high-grade bonds, the LQDs and the government bonds out in that 10 to 20, 30-year span started to pick up steam. And we've seen that before. We talked about it at the time. So the bond market has gone from the bottom of that channel to now to the midpoint of it. And there was a spike up in October in the bonds, and we've gone back to retest that in the last month. It's a level that's up close to what we saw in 2012. There's a beautiful resistance line coming down. It's what we call a speed line. We actually project it from the high before prices get up there, and it gives you a potential resistance area. And we've been up there a couple of times now, October and just a couple of weeks ago. Typically, bond highs take the better part of 2 to 2.5 months to go through a bit of a distribution and then have a hard correction. So I think we're in the position to get an appropriate correction here in the early part of this year.
Ross, what's going to happen in oil?
Well, let's hope that it finds a bottom in the near future. We do have a market that still is pretty much just hunting for a bottom. It's been as oversold as we've seen at pretty much any time in the last 5 or 6 decades. That doesn't mean we have to turn, but it does give us an indication that we're ready for some decent bounces here. So there are 2 periods of seasonality in terms of strength that we would take a look at for crude. One is the late January through May, and another one is July through September. So we're approaching that window where we might start looking for a low. Now, this is technical. This is independent of what OPEC or anyone else is talking about for production, lack of production cutbacks and their ability to hold on regardless how low the oil prices go in terms of maintaining their output. But from a technical perspective, what we want to be looking for is that possible window at the end of January for a bottom. In terms of the energy stocks, it's also got that same period to take a look at, late January. However, the rally, if it takes place, usually carries through into June. Now, one item we have mentioned that I think is significant here, it's the gold to oil ratio. There's a channel that this has been running in terms of the prices going back, dating prior to the OPEC oil embargo in the 70s. And we are right at the within just a spitting distance of the outer end of that channel right now. So it wouldn't be at all surprised to see oil trying to bottom out in this range. We've talked about 50 to 52 dollars as a potential. And we know that when oil's had these hard breaks in the past, and this is the 6th or 7th one in 40-odd years, you tend to hit the low, bounce, and then come back for a retest numerous times, usually over a span of 6 to 8 weeks, sometimes just a little bit longer, but that's the norm. And that's how long it takes you to form a decent base and really get going. So we'll see if the lows that we've got right now do manage to hold. And you want to be looking maybe a month down the road here for something that might be more of a long-term trade rather than just coming off the year-end tax selling that we've seen in all of these resource-based stocks.
What about gold? People thought it would make a big charge this year, but instead it fell and still hasn't got back up.
Yeah, I was a year ago, I was talking about it, 2014 as being a basing year for gold, and by the summer it was still looking reasonable. The September things started to come unglued, though. That was the point at which the mining stocks started to underperform the bullion, and from there we saw that erosion right down for the next couple of months. I think we've at this point we've got upper resistance in the 1255 to 1270 range. I wouldn't be at all surprised that it tries to get up and test that again, but it's going to take a definitive close through 1300 to say that there's a base in place here. And we've got to remember this: we're measuring this in U.S. They're talking about it in U.S. dollars, and that is the single, one of the single strongest items that's sitting out there in the investment arena right now. And you point out that people, when it comes to looking at bullion, what's really important is the price in terms of your own currency. If you're in the U.S., yes, it's been a poor year for gold. If you're in Canada, or if you're in Europe, you've actually seen the gold market up marginally this year, 4 to 7%. If we're in Japan, it's up 10%. And just think, if you were in Brazil with the real, or you're in Russia with the ruble, the gold market did exactly what you want. It was your insurance product that sat there in case of currency problems, in case of problems with the government and fiscal restraints. That's really what you wanted that gold for. That's part of your insurance.
Apart from the venture exchange, North American markets did very well this past year. Can they continue this charge without quantitative easing?
Well, it's how much more quantitative easing could they have done? In theory, an economy should get strong enough at this point that it's capable of carrying itself forward. I think this is really the $1 million question for everybody. Just will it be able to follow through? Nobody's got the direct answer on that. We saw even today that they are still doing all they possibly can to try and make the monetary system work. The Chinese have come out with, quote, a plan saying that they are planning to change the reserve requirement for certain types of commercial deposits in order to tweak the loan-to-deposit ratios there. So, I mean, this is a backhanded way of going around rule changes in the financial system. So everybody's still working at a government level to try and keep this thing together. So any signs of weakness, they seem to have another item that they can pull out of the hat. Now, we are coming into, we're in an important period to start off with. You're in the sweet spot from a seasonal perspective, from late October through to early May. We've just in the middle of coming to the tail end of the Santa Claus rally period. That starts when you get, ideally, a good 3 to 5% correction in the market, become a little bit oversold into the middle of December, we did exactly that on all the broad indices in the States this year. And then you have that pop that typically will take you to the end of the year. My work shows that the optimum end of the real sweet spot on that trade is the first Friday in January, although the biggest returns happen if you hold it through the fourth week of January. But that is primarily weighted through a few exceptional years. So if we just look for the highest reliability, you probably want to be banking profits there fairly soon.
Ross, thanks a lot for chatting with us.
I wish you the best of the season.
You can contact Ross at ross.clark@cibc.ca. After the break, Gerald Celente on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Gerald Celente, publisher of the Trends Journal online at trendsresearch.com, is on the line with us from Kingston, New York. Welcome to This Week in Money, Gerald.
Hello, Jim.
The first thing I wanted to ask you about is President Obama saying he wants to warm up relations with Cuba, reopen the U.S. embassy there. They had a swap of prisoners, apparently arranged by Canada, which has always had relations with Cuba, at least for the last 50 years. What does that mean for the economy and the growth of America?
Well, it won't help the growth of America much, but it'll be very good for Cuba. And I applaud Obama on this one. I think it's long overdue that we have no relations with them. And it's also going to be a great investment opportunity. I hope it doesn't get ruined too quickly, as I've seen so many times before when countries open up and they're exploited. But as you mentioned, the Canadians have been going down there in droves for years, and a lot of Europeans, a lot of Italians particularly. So we're going to see a lot of growth there. I mean, it's only 90 miles from Florida, and Florida to me is probably one of the last places that I would want to go to. But Cuba is a whole different story. I think Cuba is going to be the hot spot in that region for many years to come.
And, of course, it's another snub for Putin because Cuba and Russia have been so close together. If you're old enough, you remember the Cuban Missile Crisis.
Not only do I remember it, I remember as a Boy Scout when we were handing out instructions on how to build bomb shelters. That's how frightened they had us. And I'll never forget the day of the Cuban Missile Crisis. I remember it well. I was in high school. When it was finally settled, I don't think it's a snub to Putin. I don't think it's going to affect that in any way, in the sense that I would believe that Putin would probably be more delighted about it than opposed to it. It's not like the old Soviet Union days, and it's not as though Russia's supporting Cuba anymore. So I think it's off the radar for Putin. That's just my opinion.
Talking about trends going into the new year, first to the markets, what do you believe are the trends for oil and energy?
Again, going back to the Putin issue, there's a lot of talk out there that this was arranged, the drop of energy prices to hurt Russia, and I think it's much bigger than that. I mean, I don't have to tell you up there in Canada, look what the loonies doing. It's going way down, as a big part of your economy, about 30% or so, is energy export related. So as the price of oil goes down, particularly what you have over there in the west with those tar sands, that's expensive oil to extract. So with the price going down so much, it's going to hurt a lot of countries. It's going to hurt not only Russia, it's going to hurt Canada, it's going to hurt Venezuela, and it's hurting in other areas as well beyond oil. See, that's the issue. You're looking at 5-year lows in commodities from copper to corn to silver. I mean, there are a lot of commodities that are getting bashed. So to me, this isn't a political maneuver. It's more of a supply and demand issue, which brings us to one of our top trends for 2015, and that's price wars. Look what happened this Christmas. Near the end of the season, all of a sudden you saw things going up 70% off. 70% off. That didn't happen. It used to be 50% off after Christmas when I was a kid. And now it's 70% off before Christmas. And then you look around the world again. There's a slowdown. China's not buying what they used to buy. That's why you have a drop in commodity prices. And who's it hurting? It's hurting Chile. It's hurting Brazil. It's hurting Australia. It's hurting resource-rich countries around the world. So beyond just commodity price wars, you're going to see price wars for retail product as well. There's too much product, and when you look at how the wealth has been concentrated in the hands of so few, there's not a lot of people to buy as much as they have. And when I say that, I'm not being, throwing out cheap lines here. It's a fact. 85 people in the world, according to a new study out, 85 people have as much wealth as 3.5 billion people. A new Pew Research study just came out in the United States about a week ago. The wealth gap is now the widest it's been in modern history. So you're going to see price wars because there's overproduction, there's oversupply, and a shortage of cash being spread out to enough people to buy the stuff.
All of these North American giants of industry forgot that the reason North America was so wealthy for an entire century was that people were paid decent wages.
Well, now it's Slavelandia. And that's when, again, when you look at the numbers, that's what they're showing. You're looking at the millennial generation, people born between 1980 and 2000. 20% of them are below the poverty line. You look at the numbers in housing that keep coming out. We still have near record low interest rates in mortgages. And yet, new applications for mortgages are down. You had the Federal Reserve come out about a week and a half ago saying that they were holding back on raising interest rates. Interest rates are at record lows. Do you know the last time the Federal Reserve raised interest rates in the United States? We're now going into just days away from 2015. Do you know the last time they raised them? Try 2006. That's right. 2006. And with record low interest rates, you still have a sputtering economy. And it's not only in the United States. Over there in Europe, they have negative interest rates. You got to pay money to keep your money in the bank if you have a certain amount in there. So even with all of this stimulus, there's no recovery going on. And there's no way out of it. So that's why we see this thing continuing to decline. We don't see any growth in the markets other than making it possible for that very small handful with the biggest amount of cash that they could get their hands on to do private equity deals, venture capitalist deals, hedge fund deals. But it's no deal for the public because they're being dealt out because of the consolidation of ownership that, you're forced to either work for the man or you don't have a job.
What kind of trends do you see for gold and silver?
Well, one of the big trends that we're writing about It's The Grand Manipulation. Dr. Paul Craig Roberts actually is the author of it. And whether it's the Forex markets or currency markets that are rigged, we know that. This isn't a conspiracy theory. It's a fact. The LIBOR rate, the interest rates, they're rigged. It's a fact. The gold markets are rigged. It's all a rigged game, one after another. They're being rigged. And Dr. Paul Craig Roberts points out, for example, with gold, that demand for possession keeps hitting record highs for physical gold, but they keep shorting it in the markets, at weird hours of the day when trading is very thin. It's not in the interests of the cheap money printers to see the value of gold go up, because that's the only way they're getting away with their game. And as I said, you saw what happened just a few weeks ago. The markets were under terrible stress. You saw the European markets, the Asian markets, one after another closing down, 2%, 2%. And then all of a sudden the stocks rally on the turn that the Fed vows, you know what they called it? Rate patience. Rate patience. Isn't that a nice word? These people, they should be patients in an insane asylum for how they're destroying the world economy and getting away with it. So gold is it's on a wild ride, because when they came out and said that, you saw gold spike, and then all of a sudden, boom, a couple hours later, it was down, $10 or so. So we see it as the grand manipulation, a hard game to play, but long term, I'm for gold long term. I make it very clear. We don't get any money from gold companies. We're not, as you know, the Trends Journal has no advertisers. So nobody pays me what to say. And I'm not doing anything because it's in the interest of our organization, because we have advertisers. I'm in gold for my golden years. I don't speculate on the markets. Why would I want Bitcoin's bucks when I could have bullion? And you saw, by the way, what happened with Bitcoin. You saw all that hype that went on. And again, I was ridiculed for not jumping on the bandwagon on it. And it just didn't make sense to me. It wasn't that I was against it. It just didn't add up. And you're seeing it went from $1,100 down to about $350 now. So I'm in gold for the long term.
You've come up with some new words that we should become familiar with. What is bankism?
People are saying that what we're seeing, we're talking about wages before, and we're talking about the failure of governments, trying to come up with economic policies. And we came up with the term, this is not capitalism. Stop calling it that. It's bankism. The banks are in control. And if you don't believe me, all you do is have to recall 4 words that make it clear. Too big to fail. In capitalism, there is no such thing. And the piece that's being written on bankism is being written by Nomi Prinz. And no one writes more about banks in more solid, factual, insightful, and futuristic way than Nomi Prinz, who's also the author of All the President's Bankers. So it's a banking takeover. I just went through talking about what the banks have done with low interest rates. They're robbing the people of their future. Once upon a time, people used to put money in the banks. They used to call it a savings account. That's right. You put the money in the bank and you get more back than you put in. You get what they called interest. And the interest was usually over the inflation rate. No more. We're going to take your money. We're not going to give you any interest, so we can keep giving it to the hedge funds, the private equity groups, and the vulture capitalists. You're out of the game. It's bankism. It's a banking takeover.
What kind of danger do you see from that?
Well, you have the volatile markets that you have, where you're overplaying the markets based on cheap currencies. And there's no way out of this. That's the only way they're keeping this going. There's going to be a point when that collapses. And again, it's not only the U.S. that's doing it. China. I mean, China just has a Chinese name for it. They have an estimated 70 million vacant luxury apartments. 70 million. They have entire cities that are vacant. They keep saying they're not going to pump money into the system, and they keep doing it. As I mentioned, you have negative interest rates in Europe. So there's going to be an end of the Ponzi scheme at some time. When will it happen? Again, you see how they play the game. The bank comes out and says, Federal Reserve, patience, patience. We're not going to raise interest rates.
You have another word that we should be very aware of, deconsumption.
Goes back down to price wars. People can't afford to consume. You have America, some 2/3 of our GDP is consumption-based. Once upon a time, we used to be a manufacturing country, but we won't talk about that anymore. I don't think you're allowed to. Maybe the CIA, the NSA, I think if you talked about us being a manufacturing hub at one time, you may be called terrorism now. You're not allowed to manufacture. You got to buy from foreign countries that have slave labor. So when we talk about deconsumption, people have no money. As I mentioned, you have 47 million people thereabouts in the United States on food stamps. As I mentioned, 20% of the millennials are in poverty. So you're going to see a big deconsumption trend that ties in with the price war trend. Even if I could get it for wholesale, I don't have the money to buy it. So you're going to start seeing a big downshift in retail over the long-term trends as this bubble begins to burst.
We're talking to Gerald Celente, publisher of the Trends Journal. Are you going to see more collapses or mergers in the retail business?
Oh, sure you will. And because they're working on such thin margins. Yeah, I mean, you take a company even like Amazon. When are they going to start making dough? And then you look, Sears is closing down all over the place. J.C. Penney's. Staples. Yeah, the one that Mittens Romney likes to brag about, that he began, as a venture capitalist to get them public. Yeah, and put all they used to have a thing called stationery stores. Had one right down the block over here, O'Reilly's. No more. Now what do we have? We have Staples and Office Depot. Had hardware stores at one time. No more. Now you got Home Depot and Lowe's. They're working on very thin margins. If they can't keep these margins up, the venture capitalist house of cards collapse. Happens. And that's what you're going to see more of. Again, go back to the energy game. We're looking at the United States. Prices go down in energy. Guess what? You have 20% or thereabouts of the junk bonds are in energy. And not only in the United States, it's worldwide. They invested in Mexico. They invested in Brazil. They invested in Gazprom in Russia, one after another. And again, all this being brought about thanks to the central governments with their record low interest rates that allows the Ponzi schemes to happen. You saw merger and acquisition activity in 2014 that rivals that of 2007.
Janet Yellen, the head of the Fed, says low oil prices have an overall positive effect on the economy, not a drag for it. Do you agree?
And so does Christine Lagarde from the IMF. And I disagree with both of them. You're looking at the numbers. Here are the numbers in the States. With oil selling at around $50 a barrel, the average American family will sell, and this is according to the government, they'll save the grand total of between $550 to $575 a year. That's not going to make a big difference. And again, what they're not looking at is look at all the jobs that have been created from the whole fracking and big energy development boom. How are they going to make up for that? Go back to 1986, Miss Yellen and Miss Lagarde, when falling oil prices happened. What followed it? Oh, the crash of 1987. Again, you have to look at all the other elements it's tied into. big venture capitalistic and venture hedge funds and investors putting their money in energy, and now they're not going to be able to get it out. You're going to start seeing defaults. You're going to start seeing bond busts. You're going to start seeing big derivative problems if these energy prices continue to decline.
Yes, and the jobs in the oil patch pay very well.
Well, not as much as Walmart, where most of the people there, or not most of a good part of them, are, and also they get social welfare programs because they don't earn enough. So, of course, I'm being facetious. Same thing if you work at McDonald's. You can't make a good living. Yes, they're paying very high wages, and they've boosted a lot of economies, in communities and regions. So the unwinding of this and where it's going to be made up, it's not going to boost the economy. That's very short thinking. And again, it belies the facts. And the fact is, again, according to the U.S. government, it'll put the grand total in the families' pockets between $550 to $575 a year, which at the end of the day doesn't make a big difference.
Right. But having a good paying job in the oil patch would make a big difference to a family.
That's right.
Is there going to be more war, or are we going to see a trend towards peace? Or because margins are so tight economically, would that provide the excuse for more war, more violence?
Well, the psychopaths in charge love war. I mean, we just saw what happened with the CIA report, how you have people coming out, and that's the only ones that they show in the media, are still proponents of torture and saying that it's okay to do, even though it's against international law. And you see how easy it is to take the people to war and for the people to believe it. In the United States, the majority of the people are in favor of the torture, as described by that report, anal feeding, etc. So going to war is very easy. We saw it with 9/11, and we wrote about it in the Trends Journal. I broke down George Bush's speech, and it was the day of 9/11 and 9 days later when he addressed the nation. And my words were, only a madman would speak these words, and only people dumbstruck with terror would believe them. And terrorized they were. So there was not one factual statement he said in that statement about why we should attack Afghanistan. It was all hearsay. We just saw the CIA report come out. The CIA told us that Saddam Hussein had weapons of mass destruction and ties to Al-Qaeda. They didn't. The MI6 did too. They didn't. They both gave us false information. The people went to war. We're still at war. Matter of fact, Britain announced they're sending more troops into Iraq, and the United States is back in there already. So war is a very easy path to take. We're going against the grain. On May 2nd, 2015, at the most historic Four Corners in the United States, right here in colonial Kingston, New York, at John and Crown Street, the only place where there's a pre-Revolutionary War stone building on each corner, the mayor has given us permission to close down the streets. And we're launching Occupy Peace. The website's occupypeace.us. It's based on the words of our founding fathers, no foreign entanglements. That's Washington at his farewell address. A warrior, not one of these little boys that call themselves commanders-in-chief and couldn't fight their way out of a paper bag. Franklin, Madison, Jefferson, Adams, every one of the founding fathers, no foreign entanglements. And there were foreign wars going on back then, just like today. So we're launching Occupy Peace to bring home the troops, seal the borders, and rebuild America. We just passed a budget, not we, the criminals in charge, they call themselves Congress. 80% of that budget, 80% of the budget goes toward war and war-related expenditures, including the cyber-industrial complex and the military-industrial complex. So while they're marching to war, we're fighting for peace. And that's what we're going to be doing on Occupy Peace. We're going to have takeaway programs. So this isn't just a rally to yell and scream. This is a rally to reverse the course to war, because we believe that the next war will be the one that Albert Einstein feared when he predicted that I don't know how the Fourth World War will be fought, but the third will be fought with sticks and stones.
Well, maybe it's the other way around. We don't know how the Third World War, but...
Well, I'm sorry. I don't know how the Third World War would be fought.
Yeah.
Yeah, and we don't want the forecast to come true, as Einstein said. I don't know how the Third World War will be fought, but I know the Fourth will be fought with sticks and stones.
It seems everybody and their dog has a nuke or two.
Yes, they do. And if you want to go after Putin, I think the people better get it in their mind that Napoleon couldn't pull it off. Hitler couldn't pull it off when he launched the greatest military offensive in world history. You think that NATO, who can't win in Afghanistan or Iraq, is going to defeat the Russians or bring Putin and Russia down to their knees? And by the way, you talk about propaganda, the facts are, as we state them, and they're shown, and we're only reporting the facts, the United States and NATO were behind the overthrow of the democratically elected government of Yanukovych in Ukraine, and they were the ones that pushed for that government to be the one that's in place now that is not representative of much of Ukraine. So the United States has been behind fomenting that conflict. And from the words of Victoria Nuland, America's Assistant Secretary of State, just about a year ago in Washington, D.C. at the National Press Club, anybody could Google it up, Victoria Nuland, Washington Press Club, December 2013, she said that the path for Ukraine to take was to follow the one set forth by the IMF. She said that the future of Ukraine is with Europe, and there are the tapes of her and America's ambassador to Ukraine, Jeffrey Pyatt, talking about the overthrow of Yanukovych and how they were going to put, quote, Yats in his place. And how she admitted that the United States has spent over $5 billion in Ukraine to direct its course.
I'm sure you could find wiser uses of your money.
Well, not only that, in that new defense budget, another $500,000 there. That's about what it's added up to already that we're sending to Ukraine, $3.1 billion to Israel, and to that democratically elected coup over there in Egypt that is against the law. We're not supposed to provide any money for countries that have been overthrown by a military coup, but you can't call it that. You're not allowed to, so we won't. Another $1.5 billion of our hard-earned money. Oh, and by the way, the electric isn't working in Detroit. Our infrastructure is rotting, and when you look at the numbers of poverty rising and the people on food stamps and welfare going up, it makes perfect sense for psychopaths to steal our dough and send it overseas to a dictator near you.
I thought the U.S. couldn't afford to wage war and spend this kind of money.
Well, it can't, and it's following the footsteps, of its heritage back to the English. Look what they did. Remember, the sun never set on the English Empire? What a wonderful statement that is. They're so proper. Yeah, they were slaughtering people all over the world and occupying them until it drove them under. And remember what happened when the pound used to be the reserve currency, and right now the dollar is. If the dollar stays on the path set forth by the psychopaths running the show, you're going to see the same thing happen that happened to the UK. And that's why we're launching Occupy Peace. And it's up to the people to change the future. The mayor, when he gave us permission to close down the street, he said, I'm all in favor of this. He said, we need to build communities, not nations.
Yes, having friendly neighbors around, a lot more helpful than angry ones, that's for sure.
What if Russia came and said that they were going to dictate the future of Canada? How would the United States react? It's the same thing with the United States going across the globe to go to Russia's neighbor, going to the Ukraine and telling them what to do. What if Russia came down to Mexico and started establishing policy against the United States and putting troops in there? How would they react? But it's okay for the United States to do it? I guess it's okay because the president says we're the exceptionals.
Gerald, how can people find out more about Trends Journal and Trends Research?
trendsjournal.com. We just had a big conference here also, and it was 5.5 hours. We launched the top trends of 2015, and among the new trends are dominant energy. That's going to be the big one in the coming future. Investment opportunities, nostalgia, a number of really hot trends. And they could also subscribe to that. The whole 5-hour conference was videoed, very high quality. And we do Trends in the News each weekday night, every Monday through Friday, to get you on top of the trends and ahead of the news. Trendsjournal.com, trendsjournal.com.
Gerald, best of the season.
And for you too, and Happy New Year.
That wraps up our show for this week. Thanks to our guests, Ross Clark and Gerald Celente. And thank you for listening. I'm Jim Goddard. Happy holidays, everyone. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.